The Business Innovation Zone, also known as the Biz, is the place to start for entrepreneurs in Iowa. The Biz helps entrepreneurs and startup companies focus on idea development, business models, strategy, market validation, mentoring, and networking. We also help clients connect with qualified community and state resources needed to grow their business. Throughout the year, we provide a number of networking opportunities with experienced entrepreneurs and business leaders by offering monthly luncheons and all-day seminars on marketing and finance. You can learn more about the Biz at bizci.org.
Well, welcome to the valuation segment. I'm excited to be here today. You probably heard that valuation is both an art and a science, and that is especially true for early stage companies. And so we're going to talk a lot about that today. Hopefully give you some of the basic tools and ideas you'll need to know as you approach investors on how they view valuation and maybe help you think the way they think about valuation. My name is Peter Bonstrom. I'm a manager with LWBJ. I work with JD. And my contact information is here. We'll be obviously answering your questions here today, but after today, if you run into questions or have any issues, we'd be happy to visit with you about that. The first concept I'd like to talk about today is fair market value. This is typically what investors are thinking of when they think of the valuation of your company. Fair market value, there's a couple of things you need to understand about that, is that it's a market-derived number, so it's not necessarily your idea of what the business could do, but it would be a market-based idea of what your business is. And so to the extent that you can use market data to derive the value, that is the best way to go. It's also it's a hypothetical investor. So that's important because in a particular situation, you may be able to negotiate a premium due to synergy. So if a large company is looking to acquire you, there may be significant synergies, meaning they can use your business or technology and leverage that with their customers or their technology, their business, and that can create a lot of extra value. Typically, that is not included in fair market value. There would be some exceptions to that, where if you're in an industry or a marketplace where there's a lot of transactions happening, where there's a lot of synergistic prices being paid, then you might be able to assume that a hypothetical investor may be willing to pay a premium for that. But the bottom line is it's very subjective, especially for early stage companies. And you don't truly know what the value is until you close the deal, until you negotiate it. So this is definitely an art as well as a science for early stage companies. Another key concept we should cover is the difference between an equity value and an enterprise value. An example might help us to cover this. In the purchase of a home, typically you have a down payment, cash, a portion, you pay the cash, and then you might borrow or take out a mortgage. In this example, if the house is $500,000, you may come up with $100,000 yourself and borrow $400,000. So in valuation terminology, the equity value would be the $100,000. Whereas the enterprise value would be $500,000. Basically, enterprise is a way of talking about debt and equity combined. Both types of capital, how much capital would your business be worth? We're going to talk about three basic approaches to valuation today, three basic methodologies that you should at least consider, but private companies need a starting point. When you approach investors, they're going to want to understand how you got to your valuation, and it's important to have something that you can bring to the table and show them. We also would encourage you to avoid using rules of thumb, and this is basically hearsay or general. For example, in the accounting firm industry, the rule of thumb might be accounting firms trade at 1x revenue. So if you were to use a rule of thumb, you're basically saying all accounting firms, no matter how profitable, what their growth is, trade at 1x revenue, and that would be a rule of thumb. And the difficulty with using rules of thumb is when you approach an investor, it doesn't really give them enough support to understand if that is a good multiple or a good rule of thumb. But so hopefully we can help you, give you some tools that you won't be reliant on rules of thumb. The first approach we're going to talk about today is really the most simple to understand, but it gets very, very challenging to use, especially for early stage companies. It's the asset-based approach. And really this is the most intuitive. You take the fair market value of your assets and the fair market value of your liabilities. So you deduct the liabilities from the assets to get to equity. It's really very, very basic, but it's really deceivingly simple. For example, if your company has a lot of soft assets, a lot of intangibles like technology or customers, customer lists, you've worked hard to develop those and those have value. Your workforce will have value, just the fact that you've recruited and assembled a workforce that has intrinsic value, and valuing that separately is a challenge. In addition, you may have, hopefully there's some goodwill value, and valuing goodwill as a separate asset is very challenging. So it's often used as the minimum value. If you were to liquidate the company today and sell all your assets, what would the value be? Well, clearly you're not going to accept a valuation lower than that, because you could just liquidate today, and so it wouldn't make sense to take a valuation lower than that. It is sometimes used in highly asset-intensive industries, like a real estate holding company or some kind of very asset-intensive with little growth. Or perhaps it's even used for a company that has just been formed, very early stage. You really haven't made any progress on your business plan. You haven't hit your milestones, and so you may just look at how much capital has been invested. Well, that could be an indication of value. That could be something to start with. The second approach, and this is one that we rely on quite a bit more than the asset-based approach, is the income approach. And really here we're looking at how much cash flow does this business generate, and what is the value of those cash flows. So it typically uses projections, maybe 3 years or 5 years or maybe even longer. It could be just 1 year perhaps. And you take your income, you minus out your cash-based expenses to get to cash flow. And then for cash flows that are in future years, you would discount them at a discount rate, which we'll talk about in a moment. So the inputs that are required are projected income and expenses. As I mentioned, that could be 3 to 5 years. The idea behind how much projections you need to do is how long will it take for the company to kind of hit a steady growth rate. So if your growth rate is very high in the first few years, eventually it will slow down and hit more of a, you may grow at the pace of your industry, or you may grow at a lesser growth rate.
Your cash flow number, is that pre or post-tax?
The question was, is the cash flow number pre or post-tax? It is typically after taxes. We will talk about issues where you have a flow-through entity, as Jason talked about, that does not pay taxes at the entity level. Perhaps sometimes it is appropriate to assume taxes are paid, even though they aren't being paid in reality. But good question. So it also requires a long-term growth rate after the projection period, or sometimes it uses an exit multiple. The year 3 to infinity, that's basically what we want to capture, is that your business doesn't necessarily end at any point in time, although it could, but that's where we need a long-term growth rate. So we're going to assume that every year after year 3, you grow at 5% or 3%, some lower growth rate. Discount rates are very important in the income approach, and this is basically a measure of how risky your business is. And so discount rate basically equals risk. That's how investors will think about it. I've included here a study of some venture capital rates of return from a study, different studies that have been done. These, honestly, to me seemed high for the range of what I typically see, but these are studies, and so here's the data. The stage of development obviously is critical for determining what your discount rate is. And JD talked about 5 different stages of development earlier today. Here are 4. Typically, we don't see a venture capital investing money in the startup phase, which startup would typically be less than a year old. You're doing some test marketing, you're developing your products and services. It's really in the startup phase, pre-revenue. So here, the discount rate would be 50 to 70% in that first study. So that's extremely high. The second stage of development, you might have prototypes that you know the technical risk is low, but the commercial risk may be high. You don't know if the market will accept your products, but you know they work. Second stage of development might be some products have been shipped to customers. It might be in beta phase, but it's out there. And then the bridge IPO phase is really full-scale production. So just for an example, your company may progress through these stages of development very quickly or very slowly, but let's just take an example and assume it takes a year to get through each stage of development. If you do the math, if someone has a calculator and you feel like doing it, it would be 1.6 for the midpoint of the first stage times 1.5 for the midpoint of the second stage times 1.42 for 3 for the expansion stage, and then the bridge, if you times it by 1.3, the number you should get is somewhere around 4.46. So basically what that is saying is if a VC comes in the startup phase at the end of 4 years, they would expect to get their dollar back plus about a 350% return on their investment. So that's pretty strong. And as I mentioned, these are VC rates of returns. Angels or friends and family, you may be able to negotiate a different rate. The market approach is our third approach. It's maybe how you may think about the value of your company. It's more an intuitive approach to valuation. But basically, you look out in the marketplace and you try and find some comparable companies. You calculate what those companies sold at or what the valuation was when an outside party invested. Then you calculate a multiple of revenues or some multiple, and then you take the average or median, or maybe you just pick the one that you think is the right number based on an analysis of how your company compares to those companies, and you simply apply it to your revenue or EBITDA or customers. So it's a very common approach. The main point here is that the transactions you're using need to be comparable, and that is what makes this approach different than a rule of thumb, is that you're assessing the comparability of the underlying transactions. So not only do they need to be in the same industry, but they need to be in the same stage of development, as close as possible to your company as they can be. The valuation multiples, there's a variety of multiples. If you're a pre-revenue company, you may want to do a multiple of subscribers or a multiple of square feet or some other multiple that may be appropriate. And a good point here is that if the multiples you're looking at were calculated from historical numbers, so let's say a company sold on December 31st, 2011, you calculate the multiple from 2011 financial results for that company, and then you would apply it to your 2011 or historical 1 year trailing revenues or whatever indication you're using. That would be a trailing multiple. It's also possible to calculate a forward multiple. So sometimes you can identify what the projections were for the company that was bought or sold, and then you can apply that to your projections. So it doesn't always have to be a historical multiple. It can be a future multiple, a forward multiple. So that's sometimes helpful if you are pre-revenue, identifying what multiples to use in the future.
How does your 3.5 multiplier over the 3 to 4 years stack up to what JD was talking about with the venture funds looking for a 20% annualized return?
The question was, how does the rate of return I mentioned compared to the rate of return JD mentioned earlier? And I think it's based on your stage of development. I think if you're a later stage company, you could expect a rate of return similar to what JD mentioned earlier in the 20 to 25% range. So the rates of return I mentioned, they did seem high to me, but it was based on national studies. And so, did that answer your question?
So it's a risk component. So less risk later on, the requirements are lower. So when they're working on valuation, do they start with the multiplier that they're looking for and try to back in to a valuation? Like for example, if there's a dollar amount worth $500,000, right? And they say we want to make a 3.5% return in 4 years, and so based upon that, your earnings would have to be this. And I guess I'm trying to figure out the chicken or the egg question, whether they use their anticipated desired rate of return and your projections to come up with a ownership stake. I don't think I'm explaining this very well.
Maybe I'll just make a comment. I think your projections, at least in my experience, are going to start the process. So your projections, and then they'll come up with their discount rate to come up with what they think the present value is. So I don't know if that answered your question, but typically projections would start the process of evaluation.
Peter, I also think that those percentages of rates of return, to your point, are exorbitantly high off the study, and I don't know what the date of that study was, but particularly when we talk about at the angel level and all of that, they're certainly not investing and anticipating a 40 to 60% return for early stage. And those were VC probably returns for the amount of risk that an institutional VC was going to put into a startup company versus an angel or friends and family. So I think there might have been a little confusion there as well on just the early stage side.
Yep. So those were the three approaches: the asset-based approach, the income approach, and the market approach. We do recommend, if it's possible, to apply all three, to go ahead and at least run through what each one would look at. And to the extent that you get two approaches that would yield a similar value, that is good, that helps support that your valuation is in the range of where it should be. We most often rely on the income and market approaches, and sometimes we may weight our analysis. If they do come up with a different number, we may feel like maybe the income approach is more reliable or the market approach is more reliable, but we rely on both and just weight them. There are a variety of other considerations that can be taken into or should be taken into account in evaluation. We talked about working capital earlier. Someone asked the question about working capital. This could be a situation where maybe your company has just gone through a capital raise, and so you have excess working capital. You may have a lot of cash, or you may have a working capital deficit where you have a lot of accounts payable accrued and a lot of expenses that have been incurred but not paid. So those can both be an adjustment to your valuation. Also, it is assumed that typically, as your company grows in your projection period, that your working capital will grow. And so some cash will need to be retained in the business to fund that growth. So that's typically an assumption that's made. Owner adjustments, this can be significant. Let's say the business owner is not taking a salary, and so from a market perspective, that is a cost of the business and maybe should be assumed. They're typically going to, outside investors will typically assume some sort of compensation there. Or perhaps the owner is taking excess compensation, as might be a tax strategy they're employing, and so perhaps some compensation needs to be added back. The point is to get it to market compensation.
For those entrepreneurs that are working the night job, do the venture capitals and the sophisticated angels, do they want to see that entrepreneur taking a salary, quitting the other job, fully focused, or I mean, obviously it's kind of industry dependent, but or do they want to see that person maintaining the two, the double, and forgiving their salary?
The question is, are venture capitals and sophisticated angel investors looking for the business owner to quit their day job and focus entirely on the business, or and should they take a salary or not take a salary? What are outside investors looking for? And JD, I don't know if you have any thoughts on that.
Yeah, I mean, I think one of the first questions I ask is, once the capital's raised, what are your intentions? And it better be that you're in it to win it, full time. So it doesn't necessarily have to be while you're starting the process, but that you've acknowledged that it is your full-time commitment once you get capitalized or get in a position to begin operations of the business. I don't think it's a deterrent that you have a full-time job and you're trying to get something started up. It's just that commitment beyond.
So the answer to that question was, you don't necessarily have to quit your employment right away, but it does need to be your long-term perspective, your long-term goal. So those were owner adjustments. Taxes, we've talked about that already today, how there's some flow-through entities that you do not pay taxes at the entity level. And so basically the rule there is if you're a flow-through entity, typically you should assume some sort of tax rate, a lower tax rate. Basically, in the example that Jason gave earlier, if a C Corp pays taxes at over 50% when you include the company as well as the individual taxes, compared to just the income flowing through to the owner and what tax rate do they pay. The difference could be in the 20% range, and so we sometimes see taxes being assumed at 20% to get your company comparable to other companies in the marketplace that are paying taxes. But that's an issue you may need to do some research on. Discount for lack of marketability. This is an issue that may come up, and I would urge caution when you start seeing discounts for lack of marketability. They can be tended to be overstated, but basically what this is trying to capture is that in a market approach, let's say you found some publicly traded companies and you calculated a multiple based on their publicly traded stock price. So if they're trading at 2 times revenue, and then you apply that 2 times revenue multiple to your company, which would be a private company, there would be a difference because investors in a publicly traded company, they can get liquidity in basically 3 days. They can sell their stock and it settles and they get their money. Investors in your company do not have that liquidity. They are locked in, and selling an investment in a privately held company, especially small privately held company, is very difficult and expensive. So it really depends what approach you use to get to your valuation, whether a discount for lack of marketability applies. So that's basically the rule there, is that make sure you're consistent between your indication of value, if you used a market approach, and getting to the value for your company. Sometimes you may need to have an adjustment there for marketability. And those could range from 20% to 35%. There's different studies that helped quantify that, but that's a hot button issue, I guess, in valuation is discounts. Similar to that, you might have a minority interest discount. And Rush talked a lot about not being the minority partner, not being the minority interest. And so if you're out trying to sell a minority interest, that's going to be an issue. They're not going to want to pay a pro rata price for your company if they're going to be in the back seat and not have control. So discounts, we sometimes refer to them as discounts for a lack of control or minority interest discounts. Those are going to be an issue. They often come up in where it's equity-based compensation. So you may give stock to key employees, and in those situations they may not have control. And so a discount may be appropriate, or it's also an issue where I would urge caution. We sometimes see these in the 15 to 25% range. They're a little bit less than discounts for lack of marketability. The same issue applies here, though. For example, if you're doing the income-based valuation, and let's say the owner or the key executives are taking excess compensation, well, then it wouldn't make sense to add back that excess compensation and then take a discount for a lack of control. It would be much better to leave the excess compensation in there so that the cash flow we're using for the valuation is smaller, but it's the amount of cash flow that actually would trickle down to the minority interest. And so use caution in the discounts. I'll move along here. Another issue that's already been brought up today is complex capital structures. Let's say you have preferred stock, you have common stock. So what's the valuation and how do those two interrelate? So let's take an example. Let's say your preferred stock has a liquidation preference. So if the company were to liquidate, they get their money back before common gets paid. Let's say they have preferred dividends. So they would accrue or get paid dividends at 8% until a liquidation event or until they sell. And let's say they have a conversion feature. Let's say they can convert to common if the company's sold and that's more beneficial. So this creates an issue. If you value the company today, well, common could be worth nothing because preferred gets all their money, common, there's nothing left over for common. Typically, what we would do in that situation is we would project out a scenario several years into the future. So we say, in 3 years, we expect to sell the company. We're not sure what's going to happen. We could get a good valuation. We could have a poor valuation. So you might run a couple different scenarios, calculate what each class of stock would get in that scenario, and then weight them based on the probability. It's very judgmental. There's a lot of assumptions required in this approach, but then you'd also discount that to present value, like the income approach. So that typically would assign some value to common, which is typically appropriate. Typically, common's not worth exactly zero. It may be worth very little, but not typically zero. Some current trends in valuation that we're seeing is that tech valuations tend to be high by typical, the asset and income approaches. They're very high. And key example, you're all aware of Facebook's IPO. It potentially could be worth more than Disney or Amazon. So that's incredible. And so maybe many of you are in that industry, and so that's something to be aware of and keep your eye on what multiples of other companies are doing. I guess I've talked a lot about maybe the science of valuation. The next several slides talk more about the art of valuation, and really the qualitative factors are extremely important in early stage companies. You may not have revenue, you may not have things to calculate multiples off of, but these qualitative factors are extremely important. Here, a TechCrunch interview talked about, obviously, the market will set your value. We talked about that. Managing the process and building excitement for your business, that's part of why you're here today, and that is extremely important in a good valuation. And obviously, the qualitative factors. These valuation considerations are very similar to what JD talked about earlier this morning when he talked about drafting a business plan. But we wanted to reiterate them and just talk about how they relate to the qualitative factors that you need to be concerned about. Understanding the business concept, and that's important in, are you getting traction? Are you getting making progress in your business plan? The differentiator, how is the market reacting to your products, your services, are extremely important. Outside validation, as we talked about, that's so important, and that's going to be really key when you present to a third party. They're going to want to see these things. The management team, how are you managing the process? Are you hitting your milestones? Are you making progress? The key in all of these factors is, if you recall the stages of development, the discount rates start out high and they move lower. And so moving through those stages of development is what builds the value of your business, and that's absolutely key. And obviously having the extra exit strategy is important. So I know we covered a lot of things fairly quickly. Have a question?
Yeah, as far as the management team, there's a point, in companies grow about 100 people where you have to start going from where you're managing things directly to managing to other people. How much of that do you look at when a company is starting up as far as the management team's experience?
I guess the question has to do with when you're building a company and you maybe anticipate to grow to have a lot of employees, but you don't have a lot of employees right now. What kind of experience do you expect to see in your management team now when you anticipate future growth? I think that's a good question. I don't know, JD, if you have any specific comments on that.
You're talking about supplementing management team? You're saying you have 100 employees?
No, I'm saying there comes a point where you hit that, and that's a struggle that businesses go through. We can overcome that hump. Okay, do you look for someone, for our management team, or someone to do that, and knows how to deal with that up front in when they're starting a business? Or?
Yeah, the more skilled and experienced, been there, done that, that you can get to a management team, the better off you are versus somebody that's inexperienced that hasn't run a company before, hired and fired people and managed processes. And the same skill sets apply to as you augment the management you know, to your financial, your sales people, if they have practical business experience with those questions, we're talking about validity to us. Oh, yeah, no question. No question.
Are there any other questions or comments? Yes.
Keep going, I guess. You're trying to value a company, and you are in a web-based software company, right? And you're trying to use a comparative to figure out fair market value for your company based upon comparable valuations in the industry in your sector. All you know necessarily is the amount of money that was raised. So you know that there was a valuation established based upon the money raised. This company raised $1 million in Series A and $16 million in Series B. But they're a privately held company, and you don't know what the valuations that those money, that were made. So the question is, how do you figure out what the valuations of similar companies are when you have a limited amount of information to go on?
The question is, how do you figure out the valuation of similar companies when you have a limited amount of information to go on? And the example was, you may know that a small company in your industry raised money, and maybe they raised $1 million, but you don't know what percentage of the company they sold to get those funds. And that is an issue that we do run into. I guess talking about different sources of information, there's different publicly traded companies. We talked about that. A good source is when a publicly traded company does an acquisition. If it's a large enough acquisition, they have to disclose the financial statements of the target, and it's disclosed and publicly available. So that's a good source of information. Various news articles may give you enough information to get to that valuation, but basically, there isn't a good way to convert, an equity raise at an unknown percentage into a valuation that you can apply to your company. And so I would urge caution in using a market multiple when you really don't know much about it. If you can't do enough research into it to understand if it is comparable or what the price was, it's difficult to use that information.
And a lot of times what you'll end up having to do, when we actually do valuations of mature businesses, sometimes there isn't market data available, and even in startup businesses, and it is taking your 3 to 5 year predictive model that you've built and really focusing more on the income approach than the market approach if the market data is not readily available or reliable.